I'm very excited to welcome Mart Wohlbert back to the show. Mart dives deep into what is going on behind the scenes in uranium. He just published the Contrarian Codex newsletter, which is full of this information. So super excited to download from Mart kind of what he's been looking at right now. Welcome, Mart.
Thank you very much for having me. The last conversation we had was great, and there is plenty of things to talk about because at the WNA and also afterwards, there's just so much happening, and that was reflected in what the price of uranium and, of course, the underlying equities did as well. So I'm excited to dive in.
Exactly. The thesis is playing out like clockwork, it seems, even in this macro environment. The kind of winter we've seen the last few months where everything was falling, but now it's just the fundamentals are undeniable, which is why I'm so excited to have you on. You were just at WNA, you talked to people, the World Nuclear Association, big event. What did you learn that you could share with the audience?
Oh, I learned that, and that's what I start off the uranium section of the Contrarian Codex newsletter with as well. Just I learned that my relatively conservative expectations, which were in place for a few years since the bull market really tried to get a bit on the way. Of course, 2016 was the bottom, but 2020 was when the equities really responded. It was always that, okay, let's get to equilibrium price levels first, and then we move onwards to see if we get a blow off top because of a little bit of financial entity influence, maybe some supply shocks. But what we're seeing right now has really made me rethink this relatively conservative approach because because equilibrium price levels right now, they're not at the $60-$65 level that they've had been sitting at for years. And that's some of the numbers that some of the people that I spoke with are still working with. But these equilibrium price levels to get sufficient new supply online, they're closer to $85 to $90 right now. So we're not even at that point yet, but I am not really expecting a balanced and robust just price movement upwards to those levels. I'm expecting something closer to a parabolic spike at some point due to a combination of the severe lack of supply, especially near term between this 2024 to the early stage of 2027 timeframe, combined with just an incredible amount of robust and growing demand, and as well as potential influence from financial entities. So the WNA made me come to that conclusion after talking to a lot of industry experts. And the event itself was also filled with a lot of bullishness because people see where the puck is going, and just the combination of the demand projections that they've shared from the WNA, as well as talking to some of these companies, talking to some of these utilities, and the general consensus, yes, we have really turned a corner here, and we really need to pay attention to what is next. And my two favorite quotes from the people that I've spoken with was one with a fuel buyer who noted that over in the very near term, like say the past decade, there was never really any concern about where supply may come from because the consensus was also, okay, supply was always going to come from somewhere. If you needed some supply, it was always available somewhere. But he noted that somewhere has dried up, like somewhere is drying up substantially. And substantially, I mean that with, again, being conservative, because a lot of people are saying it has completely dried up, it's gone. There still might be some left, but it's that somewhere is really like, it's not something you can deny or not something you can rely on as a utility or a fuel buyer. And then the second quote came from the largest US nuclear power plant operator in the form of Constellation Energy. And what they said, and they didn't just say this in like casual conversation, they said this on stage on a panel discussion when they were sharing the fuel report. And they noted that utilities shouldn't be reliant on secondary supply and inventory drawdowns like they were for the better part of the last decade. They should be focusing again on primary supply, because secondary supplies, they're faltering. Inventory drawdowns have been the name of the game, but inventories have been drawn out to such a level right now that we actually need to see inventory restocking again, and we're going to get into that later as well. So my conclusion from the WNA is that I might not have been bullish enough for the past few years, and the setup right now, if you would have presented me this setup back in 2020 or 2021, or even in the early stage of last year, I would have probably called you crazy. I would probably called you, if I wanted to stay a little bit more polite and not call you crazy, like overly bullish and overly optimistic. But right now we are in the middle of it, and for the coming 12 to 24 months are going to be very, very exciting for this market.
That's what uranium investors have been waiting on. It's like, when are the secondary supplies going to be used up? There's all these kind of inventories we're working through. That's why the price isn't responding. But you're saying kind of like the rubber is hitting the road now. They're like,
Yes.
we're finally at the point where the supply is just dried up, essentially. Is that true?
Yes, and rubber hitting the road is exactly the right way to put it, because of course we can talk about these financial entities and we can talk about all these other influences, but the most important part where you see the most robust price discovery is the contracting cycle. And the contracting cycle, it was the driver of the last bull market as well. Yes, we got that blow off top, and yes, that was partly because of financial entities as well. But the contracting cycle is really the main driver of price discovery to the upside. And what we're seeing right now is, I believe, 122 million pounds being contracted at the first half of this year. And we are well on the way to get to replacement rate level contracting. And that is where you, again, will see that real price discovery, because not only is price going up, volumes in these contracts are going up for the amount of uranium. Timelines are stretching into the 2030s right now. And an important development as well, which speaks to where we are in this contracting cycle, is flex options. So what we've seen over the past few years is utilities, they have these flex options in contracts where they can say, okay, we would like to take delivery of 10% or 20% more uranium to make sure that our needs are filled and make sure that we don't have to pay the prices today, and we'll just pay the price as they were stated in the contract that they signed X number of years ago. So all these contracts, they have been, if not all, they have mostly been fully flexed out. And these new contracts, they are not having the same flex position, because this has changed from a buyer's market for the better part of the last decade into a seller's market. What we saw in the last bull market is that this price discovery and these contracting volumes are directly correlated to the amount of flex that is available in these new contracts. So while we saw in the bear market, we saw a lot of flex options. Even in 2020, we saw it being close to 40%. Even last year, we saw it being close to 24%. Guess what it is at right now? We are closer to 0 to 5% of these flex options in new contracts. And that tells you where the market is right now. So this contracting cycle is heating up. And I got a very good news for the people listening in. We are yet to see the meat of the contracting cycle. I spoke with Grant Isaac as well at the conference, and he noted this as well. The fact that we are now getting into a period where the majority of the contracting still has to happen, and we've never started a contracting cycle at this high of a price point before. So we still have a long way to go. I'm expecting multiple years of way above replacement rate contracting, and that will cause a lot of upward price discovery for the sector.
Wow. Okay. So that was my question. I was like, okay, great. So there's contracting now, but what about in the next year or two? Like, will it continue to move?
Oh yeah, it's a cycle. Yeah,
Wow.
absolutely.
Okay. So we're just getting started there. You're proving that their inventories are low. They need to contract. So that's short term, big up move in demand. Okay. And then supply, you're saying, is constrained significantly. And so we made it to the point where it's undeniable, essentially. And that's why prices are going up.
Absolutely. Of course, there are also some supply mismatches. Like there are several supply issues, and we can get into that as well. But I would first want to know, with regards to contracting, that won't be the only sort of demand that's going into this market. I'm not talking about financial entities here. Again, we get into that later. But I'm also talking about inventory restocking, because inventory is profoundly pro-cyclical. What I mean by that is these utilities, they're not going to procure a lot of inventory when the price were $20, $30, $40 uranium, and then selling those for profit or to get more cash on the balance sheet when it gets to like $80, $90, or $100. It's entirely the other way around. And that may sound a little bit odd, but it's really not. Like, it's always been the case that these inventories are pro-cyclical. So what we're going to see is that while inventories have been drawn down over the past few years, they will now be stacked back up. And I would not at all be surprised, and I tell this to a lot of people when a story of inventory restocking comes up, to see these European utilities who have previously been aiming for, let's say, 2 and 3 years respectively of inventory supply. that they will now look to take a leaf out of the Japanese utility playbook and go for 5 or 6 or 7 or 10 years worth of inventory supply. Because right now we are finding ourselves at a time where, on one hand, there's a lot of support for nuclear power. So these nuclear power plants, these utilities, they are finally getting the monetary and political support needed to stay in operation. It is reflected in several polls that were conducted by the industry for them as well. There is a lot of faith that they can keep these reactors operating for longer than they first expected. And when you combine this faith of and this security of operation with the fact that the inventories are now so low and that there is there are so many problems on the supply side, and that the market is bifurcating to such an extent that it is doing right now, and it's not getting any better. You want that supply security. Otherwise, you are having a multi-billion dollar energy asset that is sitting idle without supply. That cannot happen. The governments will not let that happen, because that's a key piece of energy infrastructure in a lot of countries, in the US as well. So I wouldn't be surprised if right now they're saying, okay, in the light of these supply chain issues, this bifurcated market, we are now going for multiple years of inventory to make sure that if something happens, at least we're covered. So you have this contracting cycle, then you have this inventory restocking, and then you have even more demand for financial entities as well. And it is looking like demand is really going to overwhelm this market as long as supply doesn't really come to the market to the extent that is needed.
Okay, great. So we have big demand coming from utilities, inventory contracting, spiking, and you're saying that's just going to continue. How about financial entities? Is there another drain on demand happening or supply?
That's the X factor. Like my friend and fellow uranium analyst Justin Yoon, under the term uranium insider, likes to call it, and I think he's spot on with that. The X factor for this market is what is likely going to cause a parabolic price spike if they're going to come in with volumes en masse. That is what it's looking like is going to happen. Like, of course, you have the 800-pound gorilla in the room in the form of the Sprott Physical Uranium Trust. I spoke with John Ciampaglia at the conference as well. I hope to have him back for another interview for the Codex in the next few months. But when he noticed that there was an enormous amount of interest, there were hundreds of millions, even by some accounts, billions of dollars on the sidelines that are saying, okay, if this market is really turning, if there's really a big opportunity here, and if sufficient liquidity allows for it, amidst a more risk-on broad equities market environment, that could come in, and even a few $100 million will absolutely break this physical market, because there is simply not enough supply available in that aforementioned 2024, early 2027 timeframe. So what we're seeing right now is we're seeing Sprott with the recent announcement that they would try to implement some sort of redemption mechanism for utilities that would allow them to essentially trade closer to NAV, which makes this a lot more attractive for large cap money to bring in, because the spread won't blow out. You won't see them trade at perpetual discount to NAV, which gives these big capital groups a bit more certainty. So that would allow them to come in if liquidity is enough for them. As well as you, of course, have Yellowcake, you have Zuri Invest, you have the ANU fund, and there are new cats on the block as well, including the Singaporean PFIN fund. I still don't know how to pronounce it, but it's called PFIN Capital. And some sources note that they have, or at least have a line of sight for raising $500 million. And they are being advised by a few very smart people, including former Kazatomprom executive Askar Batibayev, who also will come to the Codex next month for an interview. So that should be very exciting, because when I spoke to him on the conference, he noted that the second half of this year and even like the coming 18 to 24 months, it will be very exciting for uranium, given everything that's happening from the demand side to the supply side to these financial entities. And what he noticed is that once like this financial capital really starts to come in, the sky's the limit. Like I can really explain this with the right words, because I can't even really believe that I'm saying this with so much capital on the sidelines. And he even noted that there are even one or two or even three more hedge funds / financial institutions / financial entities, whatever you want to call them, that are yet to come in, and they according to some sources, are bringing with them between 75 and 150 million dollars as well. So if you stack this all up, if you combine all these different financial entities, we are looking at a potential parabolic price spike that is going to surprise a lot of people to the upside. And so, of course, no guarantees. And of course, we don't need these financial entities for the thesis to play out. We are already on the way to get this to this equilibrium price level. And there's always, because of these commodities, they never stop at this price line. They always go up and they always go down through that equilibrium price level. But right now, with these financial entities, with this so-called X factor, I can't really put a price prediction on it, but I think that the odds of this price going crazy over the next few years has never been higher.
Well, that's what's fascinating about it, right? Because we like you said, the inventory contracting, we have the financial players kind of taking supply out of the market, and the price is going to go up. Now, the question with commodities is always, okay, well, when will supply flood the market? Right? That's going to bring the price down. So, because if I'm a hedge fund and I'm saying, oh, I have $1 billion, let's say, I could just buy pure physical uranium with that. What would that do to the market? It would dry it up. How long would it take for that supply to come back in and actually the price to lower? So my point is like that's the big question. When will the price finally come down because supply is actually coming in? I know we don't have a crystal ball, but you seem to think it might take a few years for all that to come back.
I don't think that. I know it. It will take years. There are a few projects that come back online. There are a few miners that can ramp up, and there are a few brownfield resource projects that can be brought back. But supply will underperform. To what extent? I don't know yet. But what we've seen so far, we've seen the biggest and the best uranium miners in the world in the form of Kazatomprom and Cameco. They have faced their own troubles due to these supply chain issues, due to inflation, due to a myriad of other problems. They have ran into their own supply chain issues to make sure that they can ramp up production. All these other miners that are further down the food chain, they are going to face these problems as well, and they might not be as well equipped to deal with these as Cameco and Kazatomprom are, because again, they're further down the proverbial food chain, so it will be harder to secure funding, to secure the material that you need, and that is also an issue. So there are three main issues with this. One, and especially the most important one, the complete drain of intellectual capital over the past decade. Like a lot of intellectual capital that actually knows how to build a uranium mine, because building a uranium mine is extremely difficult. Like mining is very, very hard. So what you're looking at right now is that all this intellectual capital, all these people that know how to build a uranium mine, they have either left for greener pastures, they're either not around anymore, or a few of them are still in the sector. But there is just not enough people that actually know how to make sure that a uranium mine either comes from brownfield restart or from greenfield all the way up to actually getting into production. The second problem, if you even have the right people, is financing. In this high interest rate environment, it's difficult to make sure that you get enough of these finances ready to say, okay, going to the bank, okay, we're going to get this uranium mine, we're going to produce uranium, we're trying to secure funding. Like there are a lot of risks involved with that, and they might not always be able to secure enough funding. So that's another risk. And the third one is just sheer timelines. It takes a long time to get these things online. And even if you would say, okay, let's just magically make all these problems disappear and say, okay, the Nichera Cube is solved, all these other like potential projects, let's bring these online, not a problem. Let's ramp up a few more supply sources here and there, and let's add a bunch of other supplies. Well, you're going to get to, in the next few years, let's say 150, 160 million pounds, and that is very, very, very optimistic if you go with those numbers. And even then, we are looking at a demand side that is showing upwards of 200 million pounds of demand, and that is not including a lot of these financial entities that are coming in. That is not including SMR demand, which, no, that is not demand for the 2030s. That is demand that is already in the market right now. And it's also not including a bunch of other demand from, for example, inventory restocking, or even governments making strategic or building strategic inventories, like we saw the Chinese doing in the name of energy security and a multi-decade view on said energy security. So what we are having right now is a primary supply side that is not coming online on time and on budget, is failing to really fill the supply demand gap right now. So we need sustained higher prices for longer periods of time into that $85-$90 range. And that makes this market extremely prone to just disruption as well. And then there's, of course, over the past decade, that primary supply wasn't really something that you needed to worry about, because you had a lot of secondary supply, you had a lot of inventories that could be drawn down. But right now, what we're looking at is that secondary supply is at around, say, 15 to 70 million pounds right now. That's very conservatively, by the way. It's likely to be even less given recent developments. But there's 15 to 70 million pounds. Let's use that number. So on 5 million pounds from it's 7 million pounds for from Mox fuel. It is 5 million pounds from Russian enrichment from overfeeding. And so what we're looking at right now, at a few million pounds here and there, you get to 50 to 60 million pounds. That is half of what it was a few years ago. And as Constellation Energy noted, utilities can no longer rely on this dwindling secondary supply and on these inventory drawdowns, which are now at much lower levels than they were a few years ago. And of course, then you have the underfeeding to overfeeding dynamics that is slowly clicking into gear right now, which, depending on the math you use, is a swing of between 30 and 50 million pounds. And in a market that is already facing a supply-demand gap that is turning into supply-demand chasm of sorts, that 30 to 50 million pounds is just, the setup is just ridiculous, with supply faltering the way that it is. And even if you go very optimistic in your supply models, we are looking at a big deficit that won't be solved at anywhere near current prices.
I love all that math you just dropped. That's because that's so important. Like, that's what really matters. And you're saying, like, it's all finally coming to a head right now. Secondary supply is drying up. Looking out, it's still going to be down. And that is just mind blowing. So in your newsletter, you talk a little bit about the supply risks, and you just mentioned some of it. But is there anything else that investors should watch out for that could be a further catalyst? I know Cameco just kind of lowered their production because Atomprom isn't increasing it that much. These are the two big players. This is what matters. So anything else you could share regarding the supply risks that are out there right now?
Geopolitical issues is definitely one of those. Bifurcation is another. With bifurcation, I mean that a lot more pounds are staying in the east. And with geopolitical issues, I mean, for example, you just have to look at Niger with the recent coup. I spoke to the name escapes me here, Orano. I spoke to the French on the conference as well. They noted, and they announced that publicly as well, just shortly afterwards, because of these problems in the country, like they can't really continue the mining operations. One of the few companies that I actually expect to become a producer in this cycle, Global Atomic, is also facing its own issues, so that will probably delay the timeline where DASA comes online. So that's millions of pounds that are facing trouble there. Today, we are seeing that there are political problems between Azerbaijan and Armenia as well, with a potential border conflict. And that brings with it some transportation issues. Well, we've seen a lot of transportation issues. I've spoken to some of the largest transporters of Class 7 materials, so uranium and nuclear fuel, in the world. And they noted that there are so many supply chain and transportation issues right now. It's not even funny. So one of the routes that Kazatomprom uses to get material to the West, given the conflict with Russia, between Russia and Ukraine right now, is that they are using the Trans-Caspian route. So they are going through Azerbaijan, through Georgia into the Black Sea, and then off to the West. But given the now, again, lighting up the border conflict between Azerbaijan and Armenia, that border is eerily close to the railroad and the supply route that they are using to get this material to the West. So if we're seeing this border conflict really like ramp up, and if we're seeing some sort of military conflict, I really, really hope that this does not happen. Just like I hope that the conflict between Russia and Ukraine doesn't happen, because all these problems, like they have real human suffering behind them. So I don't like talking about these issues, but if they do happen, like we're seeing between Azerbaijan and Armenia right now, it just adds more issues to the supply side. So I think that's definitely something to watch, and I think that bifurcation and these geopolitical problems, they don't look that like they're getting any better.
They definitely don't. So I mean, it is, and the East is kind of moving away from the West as well, and like in terms of Russia, China, and then like the BRICS, and then like kind of
Yeah.
NATO. So is it true that uranium, like that the West has access to, is much less than what the East has access to, and the East is kind of shoring up their supply via Kazatomprom, and the West kind of needs to figure it out fast where they're going to get all theirs from?
Well, the West has options, right? For example, in the fuel cycle, the West has been very reliant on Russia as like the major fuel cycle player. But the West has options, like with Contrarian ramping up, with Canada has a few options. You have the Springfields facility in the UK, you have Orano in France, attempting to ramp up production, I believe 30% by 2028 and then into 2030 to ramp up to full capacity, which is already significant now because a decade is tomorrow in this space, as some of the smartest guys in space like to say. So when contracts are being signed, like they can sign those for later this decade or the start of the next decade. You have Urenco as well that are looking at, I spoke with them at the conference as well, and they said that there was a lot of interest in their services. So if they get the right financial incentive, if they get the right contracts in place for the longer term, they can ramp up production as well on the fuel cycle. And on the front end, so the physical uranium side, the West has options. The US has not produced, has produced barely any uranium. It's ridiculous to even state that, but it's true. And given how reliant the country is when it comes to their nuclear power plants, because they are still the largest consumer in the world. China is catching up fast, but they are still the largest consumer in the world. To not be producing any uranium themselves is a problem, but they could ramp that up. Canada has options. Of course, you still have Australia, which actually today I saw some news with regards to a potential lifting of the ban of uranium mining in Western Australia. So that's another positive development as well. So there are definitely options, but the West has been reliant on Eastern supply. So Kazakhstani, Russian, Uzbekistan, supply for so long that right now it really needs to get its act together and make sure that it has its own secure supply chain for this uranium and nuclear fuel. And we are getting towards that point. But again, price is everything. We need higher price, and we've already seen price of enrichment and conversion really shoot to the upside in an incredible way. And that price discovery, just by its very nature, is coming to the front end as well for the price of physical uranium.
Yeah, it's just so mind-blowing what you're saying. I mean, it's an inflationary environment. The cost of oil, which is an input to the whole production space of getting uranium out of the ground, is important. That's getting more expensive. Everything's getting more expensive. And so
Yeah.
that coupled with the higher interest rates, which I didn't even realize how important that is. That is extremely important. Like these mines aren't going to take a loan out at 20% interest or 18% interest. Like, it's just terrible financing deals right now. It's going to constrain the supply even more. So it's all coming to a head right now. Everything people have been talking about, we're here. Unbelievable. So is there anything else that we missed? We talked about inventories. We talked about supply shrinking. We talked about massive demand from contracting. Maybe we didn't talk about the long-term picture of SMRs. We did touch on that, but anything else that people need to hear about right now?
I think that's pretty much it. We covered a lot of it, and I, of course, like the report itself that I sent you as well. It's 60 pages, of which 30 pages are dedicated just to the WNA, to uranium fees right now, and a few uranium equities as well.
Yeah.
So we covered a lot of it. Of course, more details, so we'll be in there. But what I will add to this as well is that we have seen a big run in uranium equities recently. From the lows earlier this year, we saw URNM being up nearly 60%. We saw chemical being up nearly 70%. And a few of these charts, they've almost gone vertical. And that's great to see. The good times do feel like they're back. But I will caveat with this with the fact that I will say sentiment is very bullish right now. And when everybody's on the same side of the boat, maybe you need a little bit of a correction. Maybe you need a little bit of price consolidation just to remove some of the froth, allow the hot money to either sit down or get out, only to come back when we are reaching $80 to $90 uranium. And they will. That's just the nature of this hot money. And the majority of the retail crowd is also yet to come, and that will happen as we near the top. And that's also what I've been building on. Like I'm building an exit strategy, because as much as I'm enjoying this rally right now, and as much as I think that we are going to go a lot higher for the equities as well as just the price of uranium itself, I still want to be ready for when the time comes to exit. So I will say that right now, while equities are very hot right now and bullish sentiment is abound, they might take a step back, but this market, as we discussed, it's just so prone to go parabolic in a blink of an eye. So personally, I wouldn't trade in and around too much if you're not very flexible, if you don't have a lot of experience with trading, because once this thing really goes, it won't take a backseat. It will, like, you need to strap in, and there is no telling where this may go. So in the short term, we might see a correction. Actually, it will be very healthy, and I will definitely be buying the dip. But over the longer-ish term, let's say 12 to 24 months for this market, we have a lot higher to go, and it will be very surprised if we don't see that $80 to $90 equilibrium price level fairly soon.
Yeah, I would welcome a dip based on everything we're talking about. I can't imagine that type of gift occurring where we have these fundamentals, and
That's fair enough.
maybe there's a stock market crash or something globally, and that causes everything, including the best quality stuff, to come down. So that wouldn't mind that at all, personally.
That's actually what I'm also writing about on the code. Like, I don't just focus on uranium, I also focus on macro as well. And I've been focused on the potential problems that come with a wave of treasury market issuances into a relatively illiquid treasury market, combined with around $6 trillion worth of debt that needs to be refinanced, of which $2 trillion of CRE debt is locked up in negative NPV projects, and another 15, or in total $15 trillion needs to be refinanced in the coming 2 years. And at this current interest rate environment, it feels like something is going to break. And if on top of that a recession hits, which not a lot of people seem prepared for, if you look at like price to earnings ratio modeling, if you do that for a potential recession for S&P 500, it sees the S&P drop to at least 3,500, which I don't hope is going to happen, because it brings with it a lot of pain. But it's just some of the things why I'm still holding a relatively healthy cash position, just in case something's going to happen. Again, I hope just we go straight up, and the coming 12 months are going to be all glorious, and the next WNA meeting is just going to be one giant party. But I need to be level-headed and conservative in this regard, and it's telling me that just be a little bit careful in the near term. If things go up, great. If things go down, make sure you have some cash to buy the dip. But there are very exciting times ahead.
Yeah, absolutely. I mean, every single time we see interest rates get up this high, there's some sort of collapse and crisis. And so it'd be interesting if it doesn't happen this time, but there will need to be some sort of catalyst for them to start lowering rates again, which they need to refinance all that debt, because otherwise it's totally unsustainable. So maybe they will figure out a way of getting interest rates back down to a sustainable level to refinance.
Time will tell, man. I think it's going to be messy. I think the end game for their monetary policy, and then also, of course, for commodities and energy, because on a relative base, commodities and energy are very undervalued. So when capital starts flowing back again, we see this rotation of capital in a more positive market environment. I think those will outperform massively as well, because these things are cyclical. And the beauty of cyclicality is that you will know that once the cycle turns, which it has done a few years ago, but once it really gets into the meat of that move, it's going to bring with it a lot of capital. So I think the end game is relatively clear. It's just not really clear how we're going to get to it. So will it be a soft landing? Will it be a very calm minor correction and then we go? Or will it be a lot more messy? I think you need to be prepared for both scenarios. So yeah, no, it's definitely there's definitely exciting times ahead, depending on how you want to define the term exciting.
Yeah, I mean, not to mention just the currency debasement happening, like the value of assets
Yeah,
price.
it's just all
Yeah.
kinds of things. Yeah.
Yeah. Anyway, so that was super informative. What a great time to have you on. Thank you so much. Where can people go to get access to this newsletter, which has more details, more information, and just stay on top of your updates?
They can go to patreon.com/Contrarian Codex. It's where I upload bi-weekly newsletters, including this one. It's also where I upload interviews with industry experts, such as the upcoming guests are several companies such as DPLO, Denison, but also industry experts such as Bram van der Els, who's a great uranium trader. Kazatomprom is also coming to the Codex. A few months ago, I interviewed Yonki Paglia and Grant Isaac, so there are a lot of great interviews on the way. I also offer model portfolios, a uranium spreadsheet with everything you would want to know about these companies, including a rating, their performance, their assets, and also, of course, individual analysis and timely updates. Say something happens in the uranium market on the supply side or the demand side, or for individual equities, I will make sure that I put out a timely update on that as well. And what people can expect from the Codex as well in these newsletters that I just mentioned is that I cover the macro environment as well, but also things like copper, oil, precious metals, also individual equities that are in a Codex model portfolio. And one of the recent sectors that was added to the newsletter as well was cannabis. So the moment that I started to write about it, I heard some rumblings before, and after doing a lot of research, I started to write about it. The MSOS index that I flagged in the Codex is now up 76% at the time of recording. So that certainly went very well. And I will continue to look for these contrarian opportunities in beating down markets where you can really get in before these institutions can, before the retail crowd finds them. And that's where I think you can get a lot of value and find a lot of good opportunities, like with uranium a few years ago. And there are likely going to be a lot more opportunities as well over the coming years. So I hope to welcome more people to the community. It's been growing a lot lately, and I'm very, very happy to see that.
Yeah, it really has. Thank you so much. Looking forward to get an update from you, but keep doing what you're doing. It's super valuable.
Thank you, my friend.